got big tech names selling off today. Names like Palantir, Oracle, and Coinbase among the worst performing names on the S&P 500. This comes as the equal weight S&P 500 ETF, the RSP, is starting to outperform the Mag 7 heavy S&P 500 ETF over the past week. So does this mean that a rotation is actually starting to take hold? Well, let's bring in Ariel Investments Vice Chairman and Head of Investment Group Charlie Bobrinskoy, as well as Innovator ETFs Chief Investment Strategist Tim Urbanowicz. It's great to have you both here. Charlie, you are the perfect person for me to ask this question. The great rotation under the hood for major averages right now, does it have legs?
Well, it's hard to make short-term predictions. You know we don't like to do that. But what we can say is with relative valuation. And relative valuation, small cap value, mid cap value, large cap value are all trading around their historic multiples, maybe even a little attractive, maybe a little cheap. That's very different from how large cap tech is trading, which is very expensive. And over time, the best predictor of future performance is what you pay for something going in. The lower the multiple, historically, the better the returns have been. So we do think this market is set up for value to outperform. I know I've said that for a long time. We're finally seeing it start to happen. The recent results have been very good, Morgan.
Okay. Tim, I want to get your thoughts on this market, especially the fact that a lot of folks are focused on Jackson Hole and what we hear from Fed Chair Powell later this week, with expectations pretty heavily baked into this market that rate cuts start next month.
Well, that's exactly it, Morgan. And the level of confidence that this market has that the Fed is going to cut starting in September is pretty surprising. And why it's surprising to us is we still have core inflation running right around 3%. We've been stuck in this range of 2.75 to 3.25 really for the better part of a year. And why this is surprising is, Morgan, that's not a range we typically see the Fed cutting into. In fact, we looked at every Fed meeting going back to 1970. 94% of the time when we're in that range, you either see the Fed holding rates steady or increasing them. Only 6% of the time do you see the Fed cutting. So this level of confidence, Morgan, I think is really stemming from all the pressure that we're seeing from the Trump administration. But at the end of the day, what's really important is that the Fed cuts at the right time for the right reasons. And we think Powell prioritizes his legacy over any short-term pressure. He doesn't want to be the guy that lets inflation run away on his watch. So we think he still stays with his data-driven approach.
Okay. Charlie, what are your thoughts on the Fed beginning to cut again, and how much for the value part of the market hinges on that beginning to happen?
Yeah, this is going to be a big swing because a lot of the names that are real value names are interest rate sensitive, housing related. We got a great starts number today, up about 5%. But some of the other numbers out of housing haven't been so strong. So I do think a cut in interest rates is important. The other variable I'd put into that is we really are starting to see tariffs start to have an impact on prices. Retailers had been holding back raising prices until they had better visibility on tariffs. Now the visibility is in and they're starting to raise prices. So I am short-term bearish on inflation, maybe over the next 6 to 9 months. But then longer term, I do think we're going to get to a better place with AI helping to increase productivity. And so I'm longer term more optimistic.
Home Depot was the leader in the Dow, Tim. Finished up more than 3% here, and that's despite missing on same-store sales. I realize they maintained their guidance for the year, and they saw incremental improvement throughout the quarter. Do you like this name here, and how does it set us up for the rest of retail earnings?
Well, we do. And Morgan, when we look at retail stocks, we look at consumer stocks, there has been a lot of dispersion this year, and we think that dispersion continues. And we're really looking at this in different consumer income buckets, low end, medium, and then higher end consumers. And we think the corners can do very well, but you really want to avoid that mid-tier consumer. On the higher end, we're looking at consumers that are making $100,000 or more. Their incomes have been going up at a steady rate. They've been getting good interest on their savings. Their investments are doing well. We think they're going to continue to spend. We think that benefits stocks like Home Depot. We put Costco into that bucket as well. On the lower end, when we look at stocks like Walmart, they are heavy presence in the essential goods, things like groceries, where those low-end consumers, yes, they're getting squeezed, but they don't really have another option or a lower-cost option that they can pivot to. So Walmart's outperforming the S&P 500 this year. We think they're positioned to do very well. But when we look at that middle ground, thinking about stocks specifically like Target, where they have a lot of their focus on electronics, home furnishings that are getting hit pretty hard by tariffs, that consumer in the $50,000 to $80,000 income range is going to pull back. And we think that stocks like that are going to continue to struggle. So focus on the corners, really cautious on that middle ground.
Charlie, what are the names you like right now?
Housing-related names. Residio, the old Honeywell thermostat business, Mohawk, the carpet business. We're seeing Buffett make more investments in housing. We've got lots of pent-up demand. Normally, at this point in the cycle, when depressed earnings, you'd have to pay a big PE multiple. You're able to buy these names right now at very low multiples, 11, 12, 13 times depressed earnings. When we get a turn in repair and remodel and housing starts, these names are very well positioned.